Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders as always. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today, we're happy to welcome back our good friend, Charlie Chesbrough, Senior Economist at Cox Automotive. Charlie, I know a lot has been going on since March when you were last here with us, so I'm just going to let you take it away.
All right. Well, thank you so much. And thank you to everybody for joining us today. We're going to give you the vehicle market update, and quite a bit has changed since we last spoke a couple months ago, and quite a bit has not changed. So we're going to kind of take you through all of it. What's going on with the U.S. economy. I was going to share the latest that we're seeing from our dealer satisfaction survey because there's really some interesting results there. Give you a quick update on what we're expecting for the vehicle markets, both new and used, for the remainder of this year, and then talk about the key obstacles that we know that everyone is dealing with out there: tighter inventories and higher prices. And I have to say, there's little good news on those fronts, at least over the near term. So that's something to be aware of. But let's start by talking about the U.S. economy. That is some good news out there. And this is a chart that's showing economic growth rates quarterly on a seasonally adjusted basis, going back 20 years. And really, this is just to give you an idea of the magnitude of what we've been going through over the last year with COVID. And you can see that we fell during the first quarter of last year, the economy about 5%. By the second quarter, we had collapsed 32 or 31%. Had a fantastic rebound in the third quarter of last year, and then we've had strong economic growth numbers for both the fourth and first quarter of this year. So we're really on the right track, and you can see when we look back into the Great Recession of 2008, 2009, it almost looks quaint in comparison to what we've just been going through. What really is, I think, exciting is that by the end of this quarter, most estimates suggest that we will have recovered all of the economic output lost. So we're back to full economy in terms of the output. The growth that was lost has now been made up. But one of the problems we're dealing with is that we're at a strong economy, but we've done it with fewer folks. And that's going to be one of the challenges as we move forward. At this point, we still have close to 8 million people who lost their jobs during the crisis last year and remain unemployed. So we are still behind on unemployment. The unemployment rate, the U3, which is sort of the big headline one, is now at 5.8%, but it's still above the levels we were at prior to this crisis. The expectations are that by the end of the year, this is going to fall below 5%, maybe even into the mid fours. It really kind of depends on what kind of growth we have for the remainder of this year. But the numbers have been a little bit disappointing over recent months. The most recent numbers in May, we generated almost 560,000 new jobs, but the expectations were in the 650 or above range. So not quite as many as we were expecting. So we are seeing that the economy isn't quite doing the robust job creation that we were really hoping for at this stage. And I think it's important to point out that the country is certainly doing better, but we're not all doing better at the same pace. And this is a chart that's looking at the Moody's CNN back to normal index. And on the left, you can see sort of the aggregate line. It's now sort of stuck around a 90 level. So we're still down about 10% from where we were prior to the crisis last year. And as we look across the country, we can see that some states still remain far behind the levels they were before. And you can see those in red, with Illinois and then New York State being the leaders in that, or maybe leaders isn't the right word, but they're still struggling to get back to normal. And then at the other end of the spectrum, you can see South Dakota in yellow. They never shut down during the crisis. And so they've had some strong economic news in recent months. So it's still quite varied out there, but everybody is moving in the right direction, and that's something to be aware of. But not everything is great news out there. And one of the big issues that we're starting to hear more and more about is inflation. And certainly that's been one that we're hearing about: home price inflation and vehicle price inflation. But this is one that really hits consumers hard and immediately, and that's gas price inflation. And it's important to note, I don't know if you've filled up lately, but gas prices are up, and they're at the highest point now than they've been in 7 years. We're now over $3 a gallon average in the U.S. That's up over, I think, $1.07 from where we were a year ago. So we've seen a big move in gas prices, and this is part of the reason that I think we're starting to see a little bit of a slowdown in this recovery, because people get concerned when they see rising gas prices. That's money right out of their pocket, and they have to see it every time they fill up. And for most folks, that's at least once a week. And so this is really in their face inflation. But I will suggest to you that it does present a little bit of an opportunity to make something good out of this, and that is it makes fuel economy matter again to buyers. So just keep in mind that if you have a 15,000 mile a year driver that's got currently in a 20 mpg vehicle, you can make a pitch to them with the 25 mile per gallon vehicle. You can save a lot of money, $38 a month, just by buying a vehicle with 5 miles per gallon better fuel economy. So just something to keep in mind as you are talking to your buyers out there, because this is likely to be something that they are going to start paying a bit of attention to. The other thing that we're seeing out there is there was a lot of optimism that the fuel for this recovery was just really going to make a robust second half. And this chart is showing the accumulated pandemic savings that we've had over the last year. And much of this has been growing because of all of the money that has been distributed by the federal government, and folks have just been putting it into the savings account. And so we've seen savings really exacerbate, really get strong over the last year. And now we have over $3 trillion or $3.5 trillion ready to be unleashed in pent-up savings. And the expectation is once we got on the other side of this virus and consumer confidence improved, and the vaccinations spread around the country, this money would be unleashed on the U.S. economy and create that robust spending that we're hoping to see. You can see from these numbers that we really aren't doing that yet. It still remains quite elevated. And so we should start to see this money get spent here in the second half of the year. But it may be that there is concern about this inflationary environment that's kind of holding people back from being maybe a little bit more aggressive on the spending than they would have otherwise. One of the things we watch closely is consumer sentiment, and this comes from Morning Consult. They're a survey firm that talks to thousands of people literally every day to gauge their views. And you can see here, this is looking back since January of 2020, that we fell dramatically during the crisis, and we've been making a slow, sporadic recovery since. But we're now down about 12% from where we were at a peak for this, February 29th of 2020. So we're still down a little bit, and you can see that over the recent couple of months, we're kind of stagnating here around 100. And 100 is normal. This is sort of like the plateau. Where we were before is we were much more optimistic as a country. So we're still, we're back to more normal, but we're not at the high level of sentiment that we were prior to the crisis. But we are stagnating a little bit. And again, I do think that there is some concern that inflation is going to rear its ugly head, and people are being a little bit more cautious about their outlook as a result of that. And I think I've shown this to you before, but I do think it's really quite fascinating. As that you can see on the previous slide, that purple line is showing the average consumer sentiment in the country. And it's important to note that within that consumer sentiment, you have Northerners and Southerners and West Coast and East Coast people, and you have all different races represented, and rich people and poor people, and you have Republicans and Democrats, and it's an average. And when you split out that data, you can see that even though over the last couple months, the consumer sentiment looks fairly stable, and that's what this purple line is here. Underneath it, we've seen massive change in people's outlook on the economy and their own economic circumstances based on their party affiliation. And if we look at where the country was at in February of 2020, Republican sentiment was 47 points higher than Democrats, and now it is 37 points below. So even though we know consumer sentiment has been, fell and has been rising, underneath it, there's been a sea change in the outlook for this country. And I just think this is important just for you to keep in mind, because who is in market shopping at your dealership may be a different type of customer, maybe is looking for a different type of product than what you were dealing with just even a year ago. So let's talk a little bit about dealer satisfaction. That's really quite interesting as well. On the heels of what we're seeing in the U.S. economy, there's really tremendous optimism out there. And as I'm sure you're well aware, dealers just had a fantastic couple of quarters in terms of profitability, and that really comes out in our latest survey results. Cox Automotive does a survey of hundreds of dealers every quarter around the country. We split it out by franchise dealers as well as independent dealers to get their views on the market for both new and used and how vehicle sales in general. And one of the big questions we ask is, how would you describe the current market for vehicles in your area? And our most latest data point there, you can see for across all dealers was a 67. A new peak for this measurement. We just started this about 4 years ago. So we're at a new high. Dealers out there, and in particular, you can see franchise dealers in yellow with a 77. They're very, very pleased with the way things are looking right now in the market. We haven't seen numbers like this before. And so we know that the market out there has been good at the retail point of sale. And the expectations are it's going to remain good. We ask, what do you expect in the market for vehicles in your area 3 months from now? And you can see that it's an uptick for everybody. People are still very optimistic that there's going to be very strong demand, a strong sales environment in the market over the next 3 months. I think that's fantastic, optimistic thinking. But we have real concerns that there's going to be limitations in the market that may make that difficult. And that's when the supply issue comes in. And I'll talk more about it, but we've had a lot of concerns that we've been selling a whole bunch of vehicles with very, very thin supply, almost defying gravity at this point for everything that we know about how vehicle sales work in the U.S. market. But our expectation is that we're not going to be able to defy gravity much longer, and that we're going to start to see the impact of these lean inventories, at least on top line sales. Certainly different product lines, different OEMs and brands are going to have their own responses. But in general, the situation is likely to take a turn out there. But that doesn't mean consumers aren't going to still be out looking. And one of the big number jumps we saw out there is, how would you rate customer traffic in your dealership over the last 3 months? And you can see that this number has really exploded from where it was in the first quarter to really people running out there and taking a look. And we think that this is reflecting this concern that people have about inventories, that there's a whole bunch of folks that were planning to buy in 2021. They've been hearing about this inventory story for quite some time. I know our team at Cox Automotive has been talking to dealers about this issue. Back in December, I think we were first starting to really talk about this and how it could be a major problem. And we think consumers really got wind of this, and it certainly has hit the media over the last few weeks. It's really generated a lot of traffic. We think that people have come in wanting to maybe buy a little bit sooner than they had done before. And so some of the recent sales success, we have some concerns that might be some pull ahead demand. And I'll talk a little bit about that in just a moment. And then, of course, one of the big ones is how would you describe your profits over the last 3 months? And you can see, again, new record highs for our data point, a 59 in terms of how folks would describe their profitability, and 82 for franchise dealers. So, it seems to me everybody's pretty pleased out there with how profitability has been. And I think that can really be attributed that this lean inventory environment has allowed for very strict pricing discipline. As I'm sure you're well aware, consumers aren't in a situation where they're holding the cards, that they can negotiate a better price. The manufacturers themselves have pulled back on incentives. And so it's really been a very, very different environment than what we're normally used to. And I would have to say, I think it's going to continue, at least over the foreseeable future, that the supply is going to be lean, that consumers are not going to be in a strong negotiating position. But it may be that the sales volumes themselves are going to start to suffer, so that we may not see quite the optimism from dealers as we did before, because the profits may not be as strong, but the margins may remain quite strong. So overall, we asked, what are the factors that are holding back your business? And not surprisingly, you can see at the top of this list, limited inventory. And that's made a huge jump from where we were just a year ago. And in more normal times, like in the second quarter of 2019, only about 1 in 3 had inventory issues. It's doubled since then. And so that remains one of the big issues out there. And not surprisingly, what is no longer a big issue is the impact of the COVID virus itself. You can see number 3, only 28% of respondents were calling that a big issue, down substantially, of course, from where we were just a quarter ago and of course, a year ago. And concerns about the economy have waned as well. So it's a very different environment. It's been changing quite a bit. But this inventory issue is something that we're all going to have to deal with, and it's not going anywhere, as I said. And just one other chart I wanted to share with you, talking about some of the opinion research survey that we do at Cox. One thing I thought was kind of interesting I wanted to share was just that we asked folks about whether they're going to delay servicing their vehicle. And that we saw during the crisis about last June, about 1 in 4 people was saying that they were going to delay doing any kind of service on their vehicles. Concerns about spending, concerns about the virus, all of these things were making people holding back from engaging with fixed ops servicing. But it's fallen dramatically since then. And you can see our most latest data point from the beginning of May, less than, it's fallen to 12%. So it's fallen more than half from where we were just a year ago. So that's very good news that we're going to see more folks out there getting their vehicles fixed. That should keep many of your bays busy. And what are they going to be doing? Well, it's a little chopped up here on this slide, but they're going to be doing their oil changes, their fluids, all of sort of the simple maintenance, as well as getting their tires, all of that. So I think that that's something just to be aware of, that there is going to start to be some more spending on the servicing side. So let's talk about the vehicle sales themselves and what we're seeing for the outlook. And this is what our forecast is for this year across all the different markets. So we at Cox are looking at the whole market, not just used and new, because we're selling as a nation about 55.8 million vehicles this year in 2021. That's our expectation, up from 51.6 last year, or almost an 8% increase in the number of vehicles that are going to sell this year. We see the new market rising at this point at 16.5 million. We've just revised our forecast a little bit. We were in the low 16s, but we've seen such strong vehicle sales the last couple months. It just seems implausible that the market could fall into the low 15s for the remainder of the year, and that would take us to our previous forecast. I have to say, we've all been very, very surprised with the strength of vehicle sales in the wake of this lean inventory situation, and we think that there must be a tremendous amount of digital retailing going on. That consumers are really paying attention to what inventory is available. When they see a vehicle that they like, they run out and grab it, as opposed to driving this one and then trying another one the next day. Our expectation is we're not seeing that sort of thoughtfulness and people taking their time purchasing. That it's much like the housing market, that if you see something you better jump on it, because it may be gone if you don't. And so we think that that's been one of the ways that the industry has been mitigating these lean inventories in order to meet the needs of consumers out there that are shopping. But one of the things that's interesting out there is that the fleet side of the business continues to look fairly weak. And in fact, fleet year to date is still down on a year over year basis. We're expecting fleet activity to improve in the second half of this year, but fleet is in a really difficult situation. The rental car companies, which makes a large component of fleet, they canceled a lot of their orders last spring, or I should say in the spring of 2020, when the virus first hit. They knew that that they knew that sales and the need for these fleet vehicles from travelers was going to be down significantly. So they pulled back on a lot of their orders, and they sold off a whole bunch of their vehicles that they had in inventory. But we saw that the travel side of the economies did start to come back, and really started to come back quite strong around Christmas time, and it's really been gaining steam since. These rental car companies have been caught a little bit flat-footed. They don't have quite the inventory they had before, and a lot of their new orders, when they try to put them in now, the OEMs aren't as interested as they were before. They're trying to still keep up with their retail demand, and they would much rather provide vehicles to all of you and their retail channels than trying to meet orders for the rental car market. So, rental fleet's going to be in a difficult situation, and we've seen rental car prices really rise dramatically. I think they're up over 100%. The latest numbers I saw. If you wanted to rent a car recently, you're really going to be surprised at how much you're going to have to pay. Where we've really seen growth in the market has been in the retail side, consumers buying out there. And our expectation is that we're now going to see retail sales in the neighborhood of around 14 million new vehicles this year, and that's up almost 13% from what we did last year. As I think you're well aware, and as we saw on some of the earlier charts, people have been out looking at these vehicles. They're very interested in buying. I don't know who's left to buy. We've been, who would want to buy in this crazy environment with everything going on. But what we're finding out is that when the economy's going well and when people are regaining their confidence, they want new transportation. And I think the American consumer is really revealing themselves in this environment, that they love the American car and foreign cars. They just love cars. And that hasn't changed. The pandemic has not changed that. So it's still looking like a very strong environment. But what's interesting with it is that retail lease is actually going to be coming back this year, but not to the same levels it was prior to the pandemic. And that's a little bit surprising. We're expecting lease share to be about 28% of retail activity this year. Normally it's closer to the 29, 30% range. And you would think that we've seen such a strong growth in residual values and retention values that it would make leasing more affordable, that the OEMs could really take advantage of some of the equity that and the improved residual values to offer really good leases out there. But we're seeing that the industry's not doing that. They're being very conservative on leasing. They're essentially pushing consumers into the retail side. They want you to buy versus lease. And I think it comes back to the fact that it just takes a little bit more subvention. They have to spend a little bit more to make that lease sale. And of course, you always have the exposure of guessing that residual wrong when it comes back 3 years from now. And so that is one of the kind of the interesting things, that leasing remains a little bit more conservative for the industry. And on the used side, the used market continues to look very, very strong this year. We're expecting the market to improve almost, over 2 million units to 39.3 million this year. And I guess the biggest thing to take out of the used market is that at this point, when we look at franchise retail activity across, Asian brands, European brands, and of course the Detroit Three, the role of the used market for those dealerships continues to be very, very critical. It was about 43.6% of all the vehicles they sold last year, and our expectation is it's going to be a little over 42% again this year. That's a big chunk of your business, and I don't think that's going anywhere. The used market continues to be a very, very profitable side of vehicle sales, and I think that's one of the things we're going to see continue into next year. The availability of acquiring inventory, though, is going to be a challenge, and that's something I'll talk a little bit about in just a moment. So just looking at the new vehicle sales SAR, this is a chart that's showing the seasonally adjusted monthly selling rate for overall as well as passenger cars and light trucks. And we can see that May was a very, very strong month. 17 million was the pace that we had just last month, and that was off of 18.8 million in April, the sixth best month of all time for the vehicle market, and 18 million in March. And so the last 3 months, if you take that sales pace, has been the fastest 3 months that we've had in the vehicle market since the summer of 2005, when we had all the employee pricing for all programs, no haggle pricing back then. So it's been a very, very strong last couple of months. The question we're really wrestling with is was that 17 million that we saw in in May, revealing a huge downtick from the robustness of March? That's almost a 2 million dip in the seasonally adjusted pace. That's a lot, from what we did in April and March. Is that revealing this concern that we all have about inventory? Is the sales pace being constrained? It's hard to argue 17 million is a constrained sales pace, but just visually you can see, well, it is a downtick for what we were doing before. And so this is why it's a real unknown. Was this pull ahead demand activity that we saw early in the spring when those stimulus checks first went out and everybody went out and bought? Or does demand really remain elevated, but it's simply there's just not enough product to sell, and that's forcing the pace down? We don't know yet, but our expectation is that the pace is going to start to come down lower because of constrained demand. There's just not enough supply out there to meet it. So far this year, we've been running at a sales pace of 17.3 million. I've highlighted that in green. As well as we have year-over-year sales running right now at 32% gain year-over-year. So really a very, very remarkable situation. When we compare ourselves to 2019, which may be a better comparison, the market is running this year about 1.7% higher year to date. Well, we did 17 million back in 2019. So we clearly are on pace at this point to do a little bit above 17 million. but our year-end forecast is 16.5 million. So we're expecting that in the second half of this year, the pace is really going to start to slow because of some of the pull-ahead demand that's already happened. We've pulled ahead some buyers, and the limited choices that are going to be out there, the limited supply. We do think that's going to start to take a bite. And why do we think that? Well, there's some interesting numbers popped out from the May numbers. You can see I've highlighted in red. Car share in May was 24.2%. That's the highest that we had since I think over the last 2 years as a month. Uh, and a big jump. And in fact, if you look at what car share has been doing since December, car share hit a bottom of about 20% in December and has been rising every month since. And are we saying, oh, the bottom of car share is over? Well, it's maybe too soon to declare that, but it may be that all that's left out there on dealer lots. So that's why it's starting to sell. And I've at the very last number here, you can see year over year in May, passenger car sales were up 48%. Light trucks were up only about 39%. So we're seeing the car sales are really starting to gain some steam in both April and May. But again, that may not be because that's what consumers really want to buy. It may be that's all there is to buy. And just looking at year-to-date sales comparisons for the different brands, I chopped up the Asian brands all together and the European brands, and then the Detroit 3. I kept Tesla outside of all of this. But I do think it kind of reveals something interesting going on in the market. And in blue, this was what monthly sales were through the course of the year in 2019. Light blue is 2020, and then red is what we're doing so far this year. And really, the key takeaway from this is that both the Asian brands and European brands are doing well above what they had done back in our last normal year of 2019, that their pace so far year to date looks very, very strong. And yet you can see on the far right, the Detroit 3 pretty much was following along the same pattern as everybody else in 2020. But this year, starting around March, we saw a divergence, and that the Detroit 3 are now starting to sell substantially less. And I think we can directly attribute this to a lot of the issues that we've had with inventory. They've been hitting some of their big products particularly hard. The F-150, the Chevy Silverado, the Chevy Equinox, the Ford Explorer. All of these vehicles are big sellers for these manufacturers, and they really are at very, very low levels of supply. And some of these vehicles, particularly these pickup trucks, there's so many configurations, 30, 40 different configurations of these vehicles. And many times these pickup buyers, they want exactly what they want. They want the configuration, the crew cab with the extended bed, or a regular cab with a short bed. There's all different ways to slice these vehicles up, and it requires a lot of inventory on dealer lots in order to meet all the individual demand out there. That may be having a constraining effect on sales. So we're starting to see that for the Detroit 3. When we want to evaluate, well, how are the brands doing year to date? Well, this is a little bit of a difficult question because everybody's basis from last year is so varied. So I don't know that this slide necessarily clears it up, but I did want to put it out there just so you can get an idea of, in dark blue, this is the year-to-date change from January to May of this year versus 2020. In light blue is the January to May year-over-year difference between 2020 and 2019. So think of the light blue as the reaction to the initial crisis year over year, and then the dark blue is what it's been this year versus that crisis last year. And you kind of have to do it this way because we can see on the far right here, Buick is looking at fantastic year over year sales gains. They're up over 60% on a sales basis, but they were down almost 40% last year. So they fell hard and now they're rebounding some. So that's the numbers can be a little bit misleading. Tesla can certainly make the case that in the worst of the crisis, they were up last year almost 20%, and they're up this year. So they're the only manufacturer out there that's up both years. But if we had to really evaluate who were the winners, well, you probably want to look at who didn't fall so far last year. So they didn't fall a lot, but they're also up a lot this year. And I think if you do it that way, you can look at sort of a Volvo, a Mazda, a Kia. These companies on a relative basis appear to have held up pretty well and are doing fairly well this year. But the issues are so varied out there, and I'm going to go into that in a little bit. But the geographies and the strength of individual economies around the country, all of it's having an impact on vehicle sales. So it makes it very difficult to declare winners and losers. Looking at the overall light vehicle market right now, this is coming from our vAuto listings data. We can get a pretty good idea of what the sales pace looks like out there for retail sales. And you can see, look at how robust it is in red there. That's what we're doing in by week in 2021 versus what we did in 2019 and 2020. We're well above that dark blue line back in 2019. We're up 25% in our most recent data on a year-over-year basis. So retail activity is tremendously strong out there. And I keep saying that over and over again, but that's really one of the most remarkable things given all the craziness that we have. But we also have average list price rising, and that's going to be a major headwind for the market. Once we start to get cooler heads out there, people are going to realize that, boy, these vehicles really are expensive and the prices are rising at a pretty fast clip, and probably rising faster than wages are rising out there. We can see on the left, this is looking at 2 years of a weekly average listing price. There is some seasonality to this, that prices tend to go up around Christmas time as the new model years roll out and a lot of luxury vehicles are purchased in Q4, and then we back off. But you can see on the left, this is looking at the year-over-year change over the last year, and clearly we've had an upward trend in sales. Little bit of the numbers are starting to be a little bit volatile because we're comparing to this crazy period of last April and when the market was suppressed and factories were shut down. So some of the pricing gets a little bit odd, but you can see on average we're still rising at a 5 to 6% clip for the new vehicle market, and that's going to be something we're going to be dealing with for quite some time. So let's talk about the key obstacles we're dealing with. Well, inventory, that's a big one. Our most recent data shows that the new vehicle inventory right now is 43% below where it was this same week last year. We've got 1.3 million fewer vehicles right now out on dealer lots. This is what we're talking about when we say that it's a very, very tight market out there. Looking at days of supply, well, that looks at, it's a metric that's looking at how have sales been selling over the last 30 days. How long will your existing inventory last, given that's the sales pace that we're doing each day? And right now you can see that red line, that the days of supply is in territory that we've unheard of for this industry. Our most recent data point was 35 days of supply. Our future data points, which we kind of hold back because they're a little bit volatile, shows it's going to continue to tighten more. And our expectation is that there's really the pace of demand right now is higher than the pace of production. There's no way to sort of alleviate this problem until we start to see consumers back away from wanting to buy these vehicles. It's going to just continue to drive the days of supply lower and lower because there is such interest out there. And we can look at the different brands out there because it is quite a varied situation. We tend to talk about the nation as a whole, but that's just an average across all the different brands, and many are in a very different situation. We can see the Toyota and Lexus, those two brands, the tightest in the industry. Toyota always runs things a little bit on the lean side, but clearly they're in territory where it looks like a vehicle arrives and by the afternoon it's out the door already. But there's others as well. A Chevrolet, as I said, Silverado has really been impacting them hard, and their market share has actually been taking a dip this year as a result. GMC, a lot of their pickup trucks have been hit by the chip shortage significantly. So some manufacturers very, very tight. At the other end of the spectrum, you can see Alfa Romeo, Infiniti, Genesis. Some of the very small luxury players appear to have quite a bit of supply. So again, it's a varied situation out there, as I'm sure you're well aware, but it also varies by the different product segments as well, not just the brands. And we can see that on the far left here, the product segments with the very tightest supply, minivan, a little bit surprising, but there's been some real problems with minivans for FCA, or I should say Stellantis, out of their Ontario plant. I think we've seen some that's been hit hard by the chip shortage. But also we can see full-size SUV crossovers, luxury full-size SUV crossovers, mid-size SUV crossovers, big pickup trucks, mid-size pickup trucks. You can see there's a theme here that big crossovers and pickup trucks are in very, very tight situation. If you look on the far right, you can see full-size car, entry luxury car, high-end luxury car. There's a theme here, and that's car. And so everybody's pretty lean out there, but you can see that the car segments continue to have a little bit more inventory. And as I showed you on a slide just a couple slides back about car share making a move in May, this is exactly tied to that. I think what we're seeing is that the car inventory is what is available, and folks are having to compromise. They're having to buy maybe not necessarily what was their first choice of a vehicle. And then, of course, there's quite a bit of variation out there by geography. I pulled out the top 20 DMAs, and you can see Miami, Fort Lauderdale, Tampa, St. Pete, Florida in general, which has had very open economy during this whole crisis. I think they reopened much of their business activity well before other states did. As a result, we're seeing a lot of business activity down there, and their days of supply has been drawn down substantially. At the other end of the spectrum, you can see a lot of the East Coast big cities, Washington, D.C., New York, Boston is in there. And of course, Seattle was an early victim of the pandemic back last spring. And so they have, relatively speaking, higher levels of inventory. But again, we're talking about even in New York, which is at the far end here of the top DMAs, they still have around 40 days of supply, far below the 2-month sort of rule of thumb that the industry had for a long time. And I think that's one of the questions we have to ask is that, are we entering into a new normal within the inventory situation? Does the manufacturers, as well as dealers, do all of you prefer to be in this tight inventory environment? Can we change consumers to actually ordering vehicles and waiting 2, 3, 4, 5 weeks for that vehicle to be delivered? Or have we already trained American consumers to go in the morning and go home an hour later with a vehicle? That's one of the big questions we have to ask, because it certainly would be advantageous in many ways for the industry to keep these lean levels of inventory. Everything's great as long as vehicle sales remain strong, and I think we're entering that guinea pig phase of the market here in June. This will be the wake-up call. Can we see another 16.5, 17 million selling rate in June? Or are we going to start to see that the numbers come down? That's really the big experiment. Just looking at some of the big nameplates out there, you can see Toyota RAV4 right now appears to be the tightest vehicle out there in the marketplace, at least by our measure, with days supply hovering near 15 days. And you can see RAV4, Tacoma, Toyota Corolla, Toyota Highlander, Toyota Camry. A lot of Toyota names there on the far left. Which is why we're seeing the Toyota is in such a tight supply situation. And we can see, Chevy Traverse, Chevy Silverado. That's part of the reason that Chevy has been in such a difficult situation. And then at the other end, you can see that Honda and Hyundai, some of their big sellers are actually, relatively speaking, in a much more advantageous supply situation. This could be a real opportunity to steal some market share from some of your competitors out there. If you can't get the one product you want, you might be able to find it at the same product type at one of your competitors. So that'll be one of the interesting things to look at is what was the loyalty out there? What fell first for consumers that wanted to buy? Do they stick with the same brand but just buy a different product? Or do they stick with the same product type and just go to another brand? I think that's, again, one of the guinea pigs that we're looking at there. But it's not all bad news having tight inventories, as I said. Certainly it frees up a lot of capital for dealers to not have to have this much inventory sitting on their lots. And for the manufacturers themselves, it has allowed them to cut back on incentives. And that's what this chart is showing. The incentives as a percent of average transaction price fell to a 9-year low in May. We haven't seen those levels since back in October of 2012. That percentage. So that was the early days of the Great Recession recovery. So we've seen a massive pullback in variable marketing spending from the manufacturers. There's not going to be a lot of negotiating out there. We have heard about a large portion of vehicle sales selling above MSRP at this point. It's really just kind of crazy days. We just have not seen this in this market, at least in the 25 years that I've been doing automotive. It's really quite amazing. Can they maintain this? Again, this is something we have to see. The incentives is very, very thin out there, but sales remain strong. It's not usually a combination that we've seen before. But it does seem that the incentives are likely to remain lean uh, because one of the key drivers of incentives really getting larger in the second half of the year has been the rollover of the new model year. And in this year, we're actually in a very interesting situation where the share of the supply that exists out there, yes, we know that supply is down about 1.3 million units, but within the supply that does exist, there's a much greater share of new model years, model year 2021 in that existing supply relative to the model year 2020s we had last year and in 2019. And there's much fewer of the old product. The model year 2020s, there's much fewer of that that we have this year. So we've got less of the old, more of the new, and that's exactly what the industry wants as they go into the second half of the year, because they want the new products to be out there. They don't want to have to do heavy incentives on the old model years. And so it does suggest, at least the mix that we've got, that there is going to be pricing discipline going into the fall for the manufacturers. And just to take you through what we're seeing for the used market, it's also in a very tight supply situation. We're only able to track the used activity that's happening through car dealers. There's a whole bunch of vehicles that sell through Facebook and Craigslist and within families and friends that we're not able to capture. But of the sort of the retail activity in the used car side of the business, you can see that supply is down about 10% from where we were at this point last year, and certainly far below the blue line that we had back in 2019. And days of supply there on the right, you can see that we're looking at days of supply again near about 35. It's starting to creep up a little bit from where we were before. And that's one of the interesting nuggets out there, is that the new market continues to show days of supply tightening a little bit. The used market is actually showing days of supply loosening a little bit. So they're headed in sort of a little bit of a different direction, but they're both clearly in a very tight supply situation. And the reason why the used market is starting to slow a little bit is that the pace of sales is starting to slow, and that's allowing the day's supply to catch up a little bit. And you can see that in the red line here, relative to where we were, we saw a huge surge of activity during the early tax season days when those first stimulus checks went out back in March and April. We saw a huge surge in used vehicle activity. It's now starting to back off a little bit, as it normally does, but you can see it is falling back more closely towards 2019 levels. And we expect that that pace is likely to continue because of the limited inventory out there. It is going to constrain much of this activity. And then lastly, I just want to spend a few minutes talking about vehicle prices. Uh, the used vehicle market in particular is showing huge price inflation. I think that we just saw the CPI numbers came out today. They're showing inflation in many parts of the economy, and they cited used vehicle prices along with their numbers. And you can see on the right here, I'm showing, or excuse me, on the left here, I'm showing the change in average used vehicle list price over the last 2 years. And look at just how it's exploded. It's up almost $5,000 in just the last 2 years. And if we look on the right, looks like my chart got cut off, but this is over the last year, weekly data. You can see the weekly year-over-year change in price has only been growing through the course of the year. And the most recent data point is showing that prices are up about 23% from where they were this same week last year. So this price inflation has been really hitting the used vehicle market. And we're seeing these high prices in our Manheim auctions. And this is showing the year-over-year change in the Manheim index. And this is a data that we have about 25 years worth of data. Historically, we see about a 1.3% gain in the used vehicle value index. Much of that sort of new technology components sort of cause some inflation and just underlying inflation that exists across the economy. But you can see over the last couple months, this thing has just exploded. Manheim prices are really at historic levels that we haven't seen before. And what all that means is that retention values had really started to make a move. In this chart, I find particularly interesting because in blue, this is showing the normal depreciation, or at least during normal times, of a 3-year-old vehicle that would come back from auction after come to auction after 3 years and would be estimated to be about 60% of its value in January. And then through the course of the year, that same vehicle by the end of the year would have lost anywhere from 5 to 10 percentage points of its value, sort of normal depreciation for this asset. But what we can see in the light blue line is that it started the year following a similar pattern, but then by last summer, we saw a huge shift, and that light blue line shifted to a whole new level. And that retention values became much stronger. And now we can see this red line of what we're seeing in 2021. Retention values have just exploded. They're up 22 percentage points compared to what they were in 2019. We're just seeing huge valuations out there of what's being realized at auction. It's been much higher than what anyone expected. And as a result of that, and I think I mentioned this to everyone before, but I just think it's worth repeating, that off-lease volumes, these vehicles are coming back with tremendous amount of equity. We're expecting about 4 million off-lease maturities this year. That's what's in light blue here, down from our peak, but still a whole bunch of business. And a huge portion of these are going to be realizing values much higher than what was expected when they were leased out 3 years ago. I'm sure you're all well aware of the math, but just to give you just the ballpark idea, if something was supposed to come in at 55%, and comes in at 65% of its value, that means there's about $3,500 of equity in that vehicle as soon as that consumer hands over those keys to you. That's a lot of money, and we're seeing that a lot of the volumes at our auctions are actually down because a lot of dealers, of course, are recognizing this and keeping these vehicles upstream, as we call it, and selling them themselves. And who could blame them? And there's certainly a lot of interest for them and some good profits to be made. And that's why we're seeing some of the profit numbers we saw in those dealer sentiment numbers. And just looking at lease maturities by the different brands, the big OEM parents, Toyota, GM, Honda, they're the ones that are going to have the most of these. But we have heard some crazy stories about certain product lines, certain Jeep products that are coming back with crazy valuations. People who actually have bought a vehicle 3 years ago and are turning it in essentially with no loss. There's some crazy stories out there, but in general, the vast majority of vehicles have all made a positive move. And I think one of the interesting things is this may not be necessarily a temporary move. The expectation is that we are going to see strong interest in used vehicles because there's going to be affordability issues with new, that there's a lot of tremendous product to choose from in sort of the gently used vehicle market. And all of that's going to help maintain strong price support. But when we look forward for price support for the used vehicle market, there's a lot of support still there because we know that the vehicle market is going to be limited in supply. We're post-peak. The new vehicle market sold, our peak records back in 2015, 2016. Well, those vehicles are now 5, 6 years old. They're getting long in the tooth. So we've been selling much fewer than that in the new vehicle market since. And of course, when you throw in 2020, we sold substantially less. So the future of used is going to be smaller than it was before. So that means you're going to have a lot of folks chasing a fewer amount of products. That suggests higher prices. And we also know that the mix of vehicles that's coming to the used market is going to be much more favorable. We can look in the new vehicle sales here on the left. 50% of the vehicles sold in the new vehicle market last year were SUVs, but only 39% of the vehicles sold at Manheim auction were SUVs. The future of what's coming to auction is we're going to have more SUVs, we're going to have more pickup trucks, we're going to have in the used vehicle market more of the products that consumers are really gobbling up. That, coupled with the limited supply, suggests you're going to have a lot of interest in this used market and strong price support for quite some time. So that's kind of what we're looking at right now. Just to give you just a quick summary, the economy is still recovering, but consumer fears may be holding the pace back. Certainly fears about inflation. I don't know if you've tried to find a contractor recently, but good luck. I'm hearing all kinds of horror stories out there of people who are wanting to spend money, willing to spend money. They just have no ability to spend money because everybody's all booked up already. We know that dealers have been performing well, but it may be that the inventory is going to start to take a bite in that activity, as I said, in June. And so we might see those profits start to come down. And just as I said before, the supply and price issues are not going to change substantially this year. We see that we're going to be dealing with this inventory crisis throughout this year, and it's probably not until we get into 2022 that we're really going to start to see the day supply and all of that start to catch up a bit. So buckle up. It's going to be a rough couple months, but I think we should all at least take comfort in the fact that it's not a demand side issue. People want these products. People are clamoring for these products. We're just going to have to take some time and be a little bit more thoughtful on how we're going to get these products into their hands. So those are my comments. If there's any questions, I'm happy to take them. Or if you want to shoot me an email later, I'd be happy to get back to you. And I think they're going to distribute this slide deck here in the next day or so.
Charlie, thanks so much for coming and updating us today. There's a lot of great information here. And just like Charlie said, you guys will be receiving a copy of this recording by the end of next week. If you'd like the slide deck in the meantime, you can send me an email. To those on the line, join us back here on June 22nd at 2 p.m. Eastern as Podium shares their latest insights on effective customer communication. How do customers really want to communicate with you? For more information about AIADA, visit aiada.org. Thanks for joining us, everyone, and have a great day.